Hello, and welcome back to our channel where we explore the fascinating world of Forex trading. I'm your host, Black, and in today's video, we're going to dive into the crucial aspect of trading psychological key levels in the market. Understanding and utilizing these levels can greatly enhance your trading strategy and boost your chances of success. So let's dive right into that. Now, if you're not subscribed to the channel, please make sure we do that before we actually continue, because you don't want to miss out on content that we put out on the regular, on a daily basis, to actually educate you and take your trading to the next level. With that being said, let's proceed. Now, we first have to start by defining what are psychological key levels, right? In Forex trading, psychological key levels refer to the price levels where traders' emotions and market sentiment often come into play. These levels are typically round numbers or significant milestones in the price, such as 1.000, 1.5000, or 100.000. Meaning, like in the market, prices like, let's look at a pair, and so that we can actually go hand in hand with it. Let's look at maybe CAD-JPY. Yeah, let's go to the Forex market. CAD-JPY, perhaps. Okay, I always use FTMX, so let's use OADA. We have to remove all drawings. I don't think I've used this chart before. So psychological key levels, first and foremost, what you need to understand is that they actually come from a monthly perspective. They're psychological key levels. They have to be strong. So you can only get them from monthly, rarely in weekly timeframes. Now, as I just said to you, these are market levels where the traders' emotion and market sentiment often come into play, or they actually just collide in the same place, right? Now, you can actually see, for instance, when we say psychological key levels, these are very strong key levels in the market, like you can hardly miss them. So for instance, in the monthly time frame right here, I can go ahead and just click on some random points where they are actually very hard to miss, right? Markets or points in the market where there was a great shift in direction, or there was a great shift in direction, or there was a great impulse push, right? So typically, for instance, in CAD-JPY, these are the 4 areas in which I can just typically randomly or say they are psychological key levels in the market. But after you place them, obviously you have to just place first the typical turning points in the market, the highest point, the lowest point, and then in between here, it's best if you place 1 point, but in rare cases like here in CAD-JPY, you can actually see 2 turning points, right? So for instance, up here, this will be our first turning point. Down here, this will be our lowest point. In between here, you can actually see this was the mid-level. As you can see here, it was reactive, 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 reactive all the way out here. And this, I've actually placed it because it's the latest turning point, right? You can see how it reacted here, and here, here and here, right? So this is the latest, psychological key level. That's where I've placed it. So after doing that, you actually have to round them off to actually the closest hundreds. So for instance, here, coordinates, you can see here it starts off at 1.2240. So you can actually just put it at 400. Right? You see like that? That's the way it's supposed to be. And then here, coordinates, okay, 416. Nah, you gotta be at 400. That's where it's supposed to be. Same thing again here. 906, so it's supposed to be 900, right? So you just round them off to the nearest hundreds, and then you're good. 32, that will actually fall to 400. So there. After rounding them off, those are your psychological key levels in the market. That means in very rare chances, when prices hit these levels, will you actually see them not react? So if prices were coming up, if they hit a psychological key level, they must drop. If they were going up or they broke the level, if they come back to retest it, they must be rejected. Break below it, you can see reaction. Came back down here, reaction. Came on this one, reaction, 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 reaction. You know what I'm saying? Reaction. All of these are just reactions from the market based off these psychological key levels because they're very strong. Once prices reach there, the pressure is so high that the markets cannot keep on going the same way they're going. They must react to them. Very high or very rarely will they not react. And the moment they don't react, it's when they're breaking the level. And once they break the level, they must come back to retest the level because it's a psychological key level that it rarely is missed. So for instance, you see here, prices broke it without reacting. What happened? Prices came back to react. Prices broke it without reacting. After that, what happened? Prices came back to retest. Prices broke here. After that, what happened? Prices came back to retest. Prices broke here. They actually had a reaction first, but then broke above. After that, what happened? Prices came back to retest. Reaction. Here, reaction. They broke below it. After that, retest. Reaction. Here was reaction. Reaction. You can see all of that. All of that. Every time prices react or break, a psychological level cannot be missed, right? Now, trading off these psychological key levels, obviously, you can't trade them off monthly perspectives unless you are a position holder, which most of us retail traders aren't. So if you're trading off these psychological key levels, you actually need to be very careful and you need to actually understand them so that you can actually know how to trade them, right? So for instance, you see here, if prices were coming on with this hot momentum and then you see they're approaching a psychological key level, how would you have reacted? Some people would have said with this momentum, prices have a very high possibility of breaking above. But then what happened? Prices, the following month, prices were stopped out and ended up closing with a hanging man. And then the next month's prices pushed lower, right? So before you actually trade off a psychological key level, you first have to wait for the candle to close and see if it has broken the structure or if it will be rejected and will react to it. So that if it will break a structure, you know it first has to continue pushing higher until a support or resistance structure before it comes back to retest it. So you can know, okay, it has broken the structure. Now we have a high possibility of going up. So you can look for entries on the lower time frames to keep on going higher until the next structure before you come back to retest it. Should prices, be rejected, you actually know, okay, prices have been rejected. So we have a couple of pips to collect all the way to the next market structure because we don't know if prices will come back to keep on to try again to break this structure or they'll keep on going lower. But what we do know is that they have been rejected from this structure and we actually can catch pips, swing with them all the way to the next structure. As you can see here, prices after being rejected, they swung all the way down to the structure in which, prices were actually there with before, right? Here you see prices went all the way up here, rejected, and then pushed all the way to the next psychological key level, reacted. So you can see here, prices were rejected. So if you went to the lower time frames, you could have looked for entries to swing with it all the way until this structure here. And then prices broke below it, retested. After retest, what are you going to do? You're actually going to take a sell and swing with it low until the next market structure, right? So it's always structure to structure, support resistance to, structure to structure. But basically, support or psychological key levels, key areas, that's how you can actually plot them. You just look for highest or turning points on the highest time frame and then round them off to the nearest hundreds, and then you have your levels. Let's look at one more pair before I actually head out. What pair should I look at? I don't know. GBP something. Pound has always the momentum. So let's look at GBP. I haven't looked at GBP in Z for a while. Should we look at that? Haven't traded it for a while. Remove drawings. So this is consolidating a lot. I don't really like it. That's why I stopped trading it actually. Look at all these ranges. Like all of this. What's this right here? What's this? If you're trading a pair like this, you need to ask yourself a lot of questions. Obviously, if you're a day trader, I wouldn't mind. But still, man, like, why? Oh, man, I'm not even gonna bother with this thing, man. Okay, so GBP CAD, let's see about that. Okay, same thing. I'm not gonna do this. GBP USD, let's finish this thing. See the difference with that? Ooh, I haven't traded this pair for a while too. Looks like, you know, okay, let's just remove drawings. So with GBP USD, you can actually see a trend. See, it's a trend, range, trend, range, trend. So psychological key areas, cool. We're going to start off from the top. These are the most visible turning points in the market. We see we spot one here. What's the next one? We can spot one here, around here somewhere. Because you see here reaction, obviously here reaction. Where else? Somewhere here. Where else? Obviously somewhere down here we have another one, right? So these are the most visible psychological key areas in GBPUSD. Obviously we have to round them off to the nearest hundreds. So obviously here it will be about 2. Oof, okay, so 2 will be somewhere here. No, we need to actually to the nearest hundreds, so we need to put that at 800 right there. 2.0800. Right here, where will that be? About 7100 right there. Somewhere here it will be about 42,600 right there. And then the last but not least, we got 19800. So after rounding them off like that, those are your psychological key areas in GBPUSD. You can apply this in any pair. You can just go to the monthly time frame, look at the most visible turning points, and then those are your psychological key areas in the market. So you have your highest points, lowest points, and then after that you just look for maybe 1 or 2 in between points, and there you have them. Those are your psychological key areas in the market. Now the lower time frames you go to, the weaker the psychological key areas are. So you need to stick to the basics, monthly, rarely on weekly. But if you do that right, you got your strong psychological key areas in the market. Once prices hit those, you're sure to catch a couple of pips, like not less than 100, because they're very strong. They're very strong, especially if you do it from a monthly perspective. Way is very, very strong. You cannot miss a 100 pip reaction from it. So with that being said, guys, I really appreciate you. If you've watched thus far until the end, I really appreciate you. Don't forget to subscribe to the channel, because you don't want to miss out on content like this that we drop on a daily. And till next time, man, appreciate you all. Take it easy out there. Peace.